Hello, everybody, and welcome back. Nordic fixed income is moving on to more investors' radar as the region combines high-quality issuers, attractive yields, and a comparatively resilient macro fundamentals. In a world where many portfolios are concentrated in global or Euro credit benchmarks, Scandinavian corporate bonds offer a distinct issuer universe, different sector dynamics, and historically low default rates, and therefore generating diversification. I'm happy to welcome Henrik Tingstorp. Henrik is the CEO of Fixed Income Fund Management of Simplicity, a Swedish asset management company. A warm welcome, Henrik.
Thank you very much, Thomas.
Henrik, to start with, could you briefly introduce Simplicity? What roles does Nordic Fixed Income play within your firm? How is the team structured? And what fundamentally differentiates your approach from traditional Euro credit managers?
Simplicity is a Swedish asset manager with a strong focus on the Nordic markets, of course. We have 37 billion in total under management, and approximately 30 billion of those are invested in Nordic corporate bonds. Our investment approach is classic. We use credit and fundamental analysis, and my team consists of three experienced portfolio managers working side by side. So we are a dedicated team with extensive experience and also quite well-established collaboration here in Sweden. We have worked together for over 7 years together, but I've been at the company for over 20 years. A differentiator from Eurocredit managers, we have this deep knowledge of the Nordic markets and also a direct access to a lot of issuers. So I think that's the main key for us when we do invest in this market. So we also like to be transparent in our process, and so everybody knows what we are doing.
Many professional investors are typically invested in global or Euro credit benchmarks. So from your perspective, what is the concrete case for carving out the Nordic corporate bond markets with a dedicated allocation instead of simply increasing an existing global or Euro credits mandate?
First of all the Nordic countries offer an exposure to strong macro fundamentals. It's robust governance and also stable economic environments. The dominant markets here is Norway and Sweden, and they lead the region. And I think it's good liquidity in those bonds, and it's also they have well-established regulatory frameworks. After the financial crisis, the Nordic high yield market has evolved into a diversified market with a lot of good managed companies across all different sectors. And the main thing I think is it's really attractive risk return profile in this market. The Nordic issuers are generally smaller, which often translates into high spreads compared to global peers. Sometimes we have a stronger covenant package, and also which include maintenance and incurrence test, depending on some ownership structures, of course. Well, the liquidity can sometimes also have less correlation to other markets, but in stress periods, I think maybe the correlation tends to increase.
You already mentioned a couple of those points. So how would you describe the market structure in Nordic corporate bonds and high yield segment compared with the rest of Europe in terms of issuer base, sector focus, covenants, and liquidity? And where do you see the biggest inefficiencies that specialists like Simplicity can exploit?
Well, I think the Nordic high yield market is dominated by small to mid-size issuers. Often the companies are unrated, and it's of course a strong concentration in the real estate, as many of you have heard. It's also industrials and financials and renewables. It's a lot of green bonds that issues here. One interesting thing is that real estate remains the largest sector, but other sectors are currently growing faster, actually. The documentation and covenants, I think I spoke about them a bit before. They are strong. Many have these maintaining covenants, which is unusual in the European markets, and at least they have this incurrence test and also some restriction on dividends. But I think the most important thing, the main opportunity for us is lie in the market liquidity and the complexity of assessing smaller unrated issuers. So this opportunity, you need to capture local knowledge. You need to have the local knowledge to capture those opportunities.
When an investor wants to broaden diversification in their fixed income portfolio, from which building blocks is a Nordic fixed income allocation typically put together? Your investment grade, high yield, global credit, private debt, for example, and what allocation size does it make sense to add Scandinavian bonds?
Well, it complements in Euro IG, Euro high yield, and also global credit allocations. We also use it as an alternative to emerging market exposures due to stronger fundamentals and also the good governance in the region. If you speak about the size, maybe we're biased, but I think 10 till up to 20% in a portfolio will make sense for diversification. So, for example, we have one fund that has a global mandate, and there we have 30% in the Nordic allocation in that one. So the main thing to add Scandinavian bonds to a portfolio is the higher yields, which you get from higher than in the euro and global credits. And as you said, the default rates are low or on the same level, at least in the euro and global level. So, and you also have this top governance ranking, of course, which supports strong fiscal reliance.
A key issue for institutional investors is the reliability of liquidity in stress periods. So what specific rules, limits, and tools do you use to ensure that Simplicity's portfolios remain manageable even in the face of eventually heavy flows and spread shocks?
This is interesting because liquidity is one of our cornerstone for the portfolio construction in the Nordic market. So we prioritize bonds with strong liquidity and apply strict limits on illiquid positions. And as you said, you need to have rules and limits to do this in a good way. So we use based on credit quality and also the total liquidity profile in the fund. We also have a position size rule where high liquidity allows us to have larger positions, and lower liquidity means that be more strict in the size of the position. We also avoid to have concentrated position in illiquid bonds, of course. But one thing that is also key, we need to have a liquidity buffer to handle like sudden outflows, which always happen sometimes. We do stress testing of the portfolios, but I think the diversification of the portfolio and the local knowledge is really important here for us to do a good management of the funds in the Nordics, and also that we have a good relationship with the liquidity providers here. So that's also important.
Which sectors, capital structures, or rating buckets in the Nordic market are you currently overweight by design, and where are you clearly underweight or completely absent for risk of or liquidity reasons?
In our fund Simplicity Företagsoperationer, we are overweights in investment grade, but we are also in all our mandates overweights in subordinated bonds in strong issues. We do that because we take higher risk on the capital structure, but in high quality companies. We are also overweight in financials, driven by this top-down view of Nordic countries, strong economics, resilient social system and governance, as said before. Underweights, actually, we're in real estate, and that's a bit strange because the absolute exposure in a global context is higher, but we are underweight compared to the market in the Nordics. We also avoid issues with weak fundamentals, poor covenants, and or low liquidity. And and also the ESG exclusions get us to be out of the sector oil and gas in a total. So that one is also an underweight. So the general approach is we like resilient companies with strong credit profile and good liquidity.
As you mentioned, Nordic Credit is often seen as a diversifier. So how have your strategies performed in recent stress periods, for example, in 2020 or during the interest rate regime shift in 2022, 2020, and 23, in terms of drawdowns, correlations, and rebound behavior versus Euro credit and equities?
Well, credit spreads widened both in 2020 and 22, leading to this portfolio drawdowns. I think that's a good risk metric to evaluate the Nordic market. Our strategy worked really well, but it's always hard in periods with strong outflows to be forward-looking. Nordic credits, if you look in the past, has shown lower drawdowns and okay recovery than European credits during these stress periods. It's a strong market structure, and the local investor base, I think, support the market. The correlation, I spoke a little bit about that before, it can be increased in these stress periods, but it's much lower than for equities, for example. And sometimes also the rebound behavior can be a bit slower than in the European market. And sometimes I think that's good because then we have higher spread for a longer time in the market. But and you've seen that for the last 3 years, for example, that we have had experienced this higher spread. And that's good for the cash flow in the fund and cash flow for the investor as well and the performance in the fund. But active management has helped us navigate these outflows and maintain the performance.
You also touched the topic before. So Simplicity integrates ESG aspects into the investment process. So how does the sustainability lens change your investable universe and risk return profile? And where do you see tensions in practice between ESG requirements and your ambition to generate credit alpha?
Our ESG integration approach, we use, of course, negative screening. As I said before, we exclude sectors like oil and gas, and we include companies with strong governance and commitment to sustainability, like they signed the Science-Based Target and UN Global Compacts and so on. But one important thing is that ESG does not override the financial objectives in the fund, and the investment must meet these risk criteria first. And also it helps us actually, the companies which has good ESG management that improves the governance quality in the company, which support, of course, long-term performance. But sometimes we experienced in the past that we have had some incidents which affected the performance. And that's, for example, in Volkswagen and Swedbank. And these situations are generally hard to forecast and avoid. But it's good governance that can generally be very important for us. So we're not solely investor with ESG factors. The financial strengths need to be our priority.
So this was Henrik Tingstorp from Simplicity Asset Management. Henrik, thank you very much for being with us today and sharing your insights.
Thank you very much, Thomas.